Hello, I'd like to talk to you today about an aspect of private residence relief which is going to be changing next year. Now, in a previous talk, I've discussed in outline this possibility because it was announced by the Chancellor back in October 2018 at the time of his main budget speech. But since that last recording, we've had the publication of a detailed consultation document, funnily enough, on April Fool's Day, 1st of April 2019, and as a result, we now have quite a bit more detail about the Treasury and HMRC's latest proposal. What we can say for definite is that the government are committed to retaining what they call the core principal private residence relief, so that no danger of that being removed. But what they have said is they're minded to make some changes to a couple of what they refer to as the ancillary principal private residence reliefs. And the consultation document identifies 4 so-called ancillary reliefs. And let me just spin through those 4, because 2 of these are going to be subject of amendment, one in, I think, really quite an important way. The first one is in relation to what's usually referred to as job-related accommodation. The classic example describing this ancillary relief would be as follows. I'm, let's say, the headmaster of a boarding prep school. Obviously, under the terms of my employment, I'm required to live in the headmaster's house at the school. And that's where I spend most of my time, if not all of it. However, I'm getting quite close to retirement, and so I think it would be nice when I do hand in my cards to have a place of my own, and so some years in advance, my wife and I go out and we buy what we consider to be the ideal retirement cottage down in Cornwall. Let us suppose that at some stage we have to call into question the principal private residence position of this Cornish property. Obviously, at the moment, while I'm still headmaster, that property is clearly not my main residence. But because I am required, because of the nature of my job, to live elsewhere, the job-related accommodation relief says we can count the period over which I own that Cornish property as using the property as my main residence. So in other words, when some years down the line I might eventually dispose of that property in Cornwall, I don't get stung for a chargeable gain. So job-related accommodation is one of the ancillary reliefs. That is not going to change, as I understand it. The second one is what's usually referred to as a final period exemption. And this is something you may remember Mr. Hammond's predecessor, George Osborne, modified some 5 years ago in 2014. The rule says that the last 36 months of ownership of a property which is or has been your main residence are automatically treated as qualifying occupation as a main residence. And you will recall that in 2014, the Chancellor decided that that was an over-generous time limit, and he halved it from 36 months down to 18 months. The only exception to that change was that he kept it at 36 months for taxpayers who either were in a care home as a long-term resident or who were disabled and suffering an appropriate level of disability. In other words, you kept the more favourable, longer time frame. That exemption is known as the final period of exemption, and that is the first of the ones that the government is thinking about making further changes to. The third ancillary relief, I suppose we might best summarise as being in relation to work-related or other absences. And in section 222, subsection 3, and you'll see all the details in the notes which accompany this talk, I have spelled out that there are certain specified types of absence which, nevertheless, if you incur these sort of absences, still count as occupation as a main residence. Very briefly, And remember, these are not either or, they can be cumulative. You could have several of these over a period of ownership. The first one is absences for whatever reason totalling not more than 36 months. So that is in addition to anything else. And we'll have a look at the impact of that in a little mini case study I've got for you in just a minute. The second says absences during which your client is in employment and all their duties are performed outside the UK. So in other words, if I'm sent abroad on an overseas assignment by an employer, but I've retained, let's say, my house back in the UK, the mere fact that I'm not living in the house at the moment, but perhaps living in a hotel or more likely perhaps a rented property in the overseas jurisdiction, doesn't matter. That time frame qualifies for principal private residence relief. Notice it's got to be someone who's in employment, not self-employed, and it has got to be someone all of whose duties are performed outside the UK. And the third type of qualifying absence or absences totaling not more than 4 years, 48 months. Again, where you are precluded from living in your main residence because of your job. But again, what we're looking at here is probably someone who is working elsewhere in the UK. And therefore, although it may not be job-related accommodation, nevertheless, clearly, if you've got a stint, let's say, working for your employer up in Cumbria, it may be a little difficult to be occupying on a full-time basis your main residence down in the south in, say, Hampshire. So the legislation says, provided you don't go beyond 48 months, or to the extent that you don't go beyond 48 months, you can get principal private residence relief for that time frame in those circumstances. And I should just mention in passing, as far as one is concerned, that for the first, but not the second and third of those types of qualifying absence, it is a requirement that you have got to have occupied the property as a main residence both before and after the absence. With the second and third, although you have to have occupied the property as a qualifying main residence beforehand, it is not a requirement that you've got to have reoccupied it afterwards. And the final of the four ancillary reliefs is what is known as lettings relief. Lettings relief is something that was introduced nearly 40 years ago. It was brought in the very early days of the Margaret Thatcher government, if I remember correctly, in the Finance Act 1980, and it was put in place at the time because, particularly in London and the South East, there was, what else is new, a significant shortage of appropriate residential accommodation, and the government decided that there were quite a lot of taxpayers, perhaps whose children have grown up and left the family home, who were still occupying the original family house or flat, but because there were now no longer youngsters there was, if you like, surplus space, but mum and dad were not renting out that surplus space for fear that in doing so they might invalidate some of their full principal private residence relief. So they came up with the idea of bringing in this so-called lettings relief, saying if you let out all or part of a property that at any stage has been your main residence, you can enjoy, when you finally come to sell that property, an additional relief, which is what we call the lettings relief. And the legislation says the amount of your lettings relief, the quantum of the relief, is the smallest of three alternative figures. The first is the amount of your client's gain which is exempt because they've lived in the property as a main residence. So in other words, they're exempt principal private residence gain. The second is a fixed monetary figure. Back in 1980 it was 10 grand. That got doubled to 20 grand in 1984 and doubled still further to 40,000 in 1991. Despite what has happened to the property market over nearly the last 30 years, it has never moved further, even though it obviously should have done. So, in other words, today, the second figure that you look at is 40,000. And the third that you factor in is the amount of the individual's chargeable gain relating to that letting. In other words, because you have let out the property to someone else, in whole or in part, to what extent does that crystallise a chargeable gain? So it's important to appreciate, currently, lettings relief is not automatically 40,000. If one of those other two figures is smaller, it's whatever is the smallest figure that is the amount of the relief. The other point I just ought to mention is, in the context of letting relief, there's a slightly surprising result in the sense that if the property is owned jointly by, say, a married couple, the lettings relief monetary limit is not 40,000 per couple, as you might guess, but 40,000 per spouse. So it could be 80,000 in total in the best case scenario. Now, the first thing that I've done, just to sort of illustrate the working of a number of those provisions, is I've included in the notes which go along with this talk a mini case study, and it's an illustration called Jasper. And what I've got is client Jasper bought a long lease flat, a 99-year lease flat, back in March 2000, obviously somewhere fairly expensive, 250,000 he paid for it, so we'll assume it's in London. So in London, and he occupied it as his main residence for 6 years until March 2006. At that stage, he decided to take advantage of the fact that the QE2, which we knew was about to come to the end of its useful existence, was going on a final 2-year round-the-world cruise. So he couldn't resist that, so he packed his bags, gave up whatever else he was doing, and embarked on his 2-year round-the-world cruise. In the meantime, his flat, of course, sat empty. He returned in March 2008 and reoccupied the property for another 7 years, until March 2015, when he changed his property. He moved to a new property. Fortunately, from his perspective, he didn't have to sell the old flat. He simply rented it out. So this is obviously where the letting relief, because a property which has been his main residence, is now being let out in those circumstances. So he let it out for a 5-year period until the 1st of March 2020, when he sold the long lease. It started off life as a 99-year lease, so 20 years on it's presumably now a 79-year lease, and he sold it at a substantial profit. So we've got the sale price, original cost £250, so Jasper's gain over the 20-year period of ownership is £600,000. And of course, as you know, what you have to do in order to work out the taxable gain, if any, is do various time apportionment exercises. The first thing we can say is how much of that gain of £600,000 is eligible for private residence relief. Well, the answer is he lived in it for 6 years. He then went on his QE2 stint. He then came back for another 7 years. So 13/20ths, or I've done the calculations in months, but we'll call it 13/20ths of 600,000 gives you the principal private residence exemption. So that'll be £390,000. So that bit isn't going to be subject to tax. We can also, of course, see, as far as one is concerned, that over the 2 years, 24 months, when he goes on the QE2 round-the-world cruise, can he not take advantage of the fact we've got, remember we said, up to 3 years for any reason in those circumstances? The requirement, of course, is that you've got to have occupied the property as a main residence before and after, which, of course, he did do following his QE2 stint. So there is another 2 years, 24 months. So 2 out of 20, 10% of 600,000, £60,000 is another bit of principal private residence exempt gain. And then, of course, you've got his final period exemption. Nowadays, as we mentioned earlier, it's only the last 18 months, so the last year and a half. So 1.5 out of over 20 times 600,000 gives you £45,000. So that is also exempt. So when we tot up his various reliefs, they come, I think, to 495,000, set against his gain of 600,000, leaves you with 105,000 taxable before the application of lettings relief. The lettings relief, remember we said, is going to be the lowest of three figures. The first one is the amount of his principal private residence exempt gain, which will be the aggregate of those three that we've just discussed. The basic private residence relief and the two ancillary reliefs, 495,000. So first up, 495,000. Second up, 40,000, being the maximum quantum. And thirdly, the amount of his gain that is attributable to the 5-year letting. Now, the property was let for the last 5 years of ownership, so 5 over 20, being the number of years of ownership, 1/4 times 600,000 gives you 150,000. But of that 150,000, we've already catered for 45,000 in the final period exemption, so the chargeable gain which is attributable to Jasper's letting of that property is 105,000. So we're looking at the lowest of 495,000, 40,000 and 105,000. Obviously 40,000 is in this instance the lowest figure. That means that of his gain of 105,000 we're left with 65,000 in charged tax, assuming he hasn't got any other capital disposals this year. Obviously we can net off the annual capital gains tax exemption of 12,000 for tax year 1920 against it, so that leaves him with a gain of 53,000 assessable. We'll assume he's a higher or top rate taxpayer, so it'll be assessable at 28%, not 18%, and that means Jasper's capital gains tax bill is going to be just under 15,000, 14,840. I work it out. So that's just quite a detailed example showing the illustration of the various ancillary reliefs. And you will recall that I mentioned that the government intend to restrict 2 of those 4 ancillary reliefs with the effect from the 6th of April next year, 6th of April 2020, on the grounds that the present situation is thought to be a little over-generous. And we've seen that the 2 that are going to be affected are the final period exemption and the lettings relief. And the reason, although it was announced back in October 2018, why the changes have been delayed to the 6th of April 2020 is apparently to give taxpayers time to sell a property under the current rules if it might be adversely affected by the restriction that the Chancellor is going to impose. So, in other words, if these changes would be bad news for your clients, there's a simple maxim: sell before the 6th of April 2020 and you'll be dealt with under the current regime and not the revised regime that is going to come in. So, just very briefly, what's going to happen in detail. Firstly, the final period exemption is going to be halved yet again. It's going to come down from 18 months to 9 months, but the special 36-month rule for people who are long-term residents in a care home or who are disabled is being retained. That is not being affected. Interestingly, I do slightly wonder whether there's a little quirk here, because what do you suppose long-term residence in a care home means? Well, I can tell you, because it's statutorily defined, it's 3 months. And that strikes me as quite a generous statutory rule. And you do wonder whether there might be, when we get to see the detailed legislation, which obviously is not yet available, when we get to see the detailed legislation, whether there mightn't be some anti-avoidance that would be put in place. Because otherwise, if we've got the situation where I'm thinking about selling my property next year, but obviously reckon that a final period exemption of only 9 months might give rise to some adverse capital gains tax effects, might I check myself into my local care home for, say, 4 or 5 months, during which I sell? Because if I'm over 3 months, I'm presumably a long-term resident, and therefore will qualify for 36 months. So that's just an interesting little dilemma to have a look at when we get to see the detailed draft legislation, which I assume is probably going to come out in sometime in July, when traditionally we can expect the draft finance bill for next year to appear. What I'm probably more worried about, however, is the Second Amendment, because the other amendment, which deals with lettings relief, is going to restrict that relief in future to those who share occupation of their property with their tenant or tenants. At the moment, it applies, lettings relief applies, whether you're living in the same property alongside your tenants or whether you've vacated the property completely and the tenants are living in what used to be your main residence. In either case, lettings relief is available. And what the change is going to do, it's going to say that lettings relief is only going to be available for those who share occupation of the property with their tenant. And what is worse, we understand that this new proposal is going to apply throughout the letting period, which obviously could include years prior to the 6th of April 2020. Take the significance of my comment that where I say that if you don't like the thought of that because you have rented out your property in toto and moved out of it, so you will not be eligible for letting relief if you sell after the 5th of April 2020. Take note of my comment that perhaps you've got to get a move on and sell that property before the start date of those new rules if you want to avoid that interpretation being applied. I understand that one or two of the professional bodies who've put in representations in relation to the consultative document have made the point that that seems a little unfair, a little unreasonable. But my gut feeling is that HMRC and the government are probably unlikely to give way on that point. But we will have to see. But the point being, the reason I'm talking about it now is if I was talking about it this time next year, when the legislation has been put to bed and become part of the Finance Act 2020, it would be too late to take any action. In addition to all this, we understand that what the government is thinking about doing is enacting a couple of extra-statutory concessions to do with private residence relief. The two extra-statutory concessions which they're looking at are D21 and D49. D21 is a slightly funny extra-statutory concession. As you know, if you've got two or more properties, you've got a 2-year period from having acquired the second property in which to nominate which of those two properties is to be regarded as your main residence. So let's envisage this as a situation. I've never been able to afford to, even though I work in London, buy a property in London, so I've lived in a rented flat. However, some years ago, I managed to scrape together enough capital to buy a little weekend cottage in Suffolk. Now, at first blush, you might say, don't have a problem. You've only got one property that you own. So when you come to sell it, obviously, given that it's a property you occupy, albeit only at the weekends, or most weekends, you'll get the relief. Oh no, says the Revenue. If you haven't nominated within the 2-year time frame, and that would obviously start to run from presumably when you bought the Suffolk cottage, you've missed the boat. And if you miss the boat under these rules, remember, basically the Revenue go de facto, in other words, on the property which actually is your main residence in reality. And clearly, the property which is my main residence in reality is, of course, my London flat, because that's where I spend most of my week, even though it's not a property I own. So what D21 says is if you didn't realise the need to make a nomination for the Suffolk cottage until after the 2 years were up, nevertheless, provided you did so reasonably expeditiously after you realised the error of your ways, they would accept it. So we assume that that is going to go into the legislation as I've described it. D49, which incidentally has featured in a couple of recent capital gains tax cases, is, I think, slightly more contentious. It's to do with delays in owner-occupiers taking up residence of a property. Typically that might be, I have bought a property from you, which my wife and I are going to move into, but we've decided that actually it needs quite a bit of refurbishment and major building work before it's fit for occupation. So obviously, although we've bought it from you, we can't move in. We perhaps move temporarily into a rented property and while the builders do their stuff in the property we've just acquired from you. And what D49 says is, provided that delay before we take up occupation does not last longer than 1 year, our occupation as a main resident starts from day one when we bought it from you. They do extend that 1 year period to 2 years, provided it's for circumstances outside our control. So presumably, perhaps the builders had difficulty getting some of the parts. So, the building or work or refurbishment stretched to longer than the initially estimated time frame. That would be the sort of situation. But the key point is that if it turns out to be more than 2 years, all bets are off. You lose everything, and you only get your principal private residence relief from the moment when you actually move in. So it means you can say, if you move in, say, sometime in year 3, that you've automatically already got a chargeable gain that will crystallise when you, at a later stage, finally dispose of that property. It's going to be very interesting to see exactly how they legislate D49, whether D49 goes in as the extra-statutory concession currently reads, or whether they're going to be a slightly kinder version of it when we come to look at the finance bill. So keep your eyes and ears open for that. And then finally, and this doesn't seem certain, but it was also included in the consultative document, it seems that there is a possible change looming to the provisions found in section 222, subsection 7, TCGA 1992. This is all to do with principal private residence relief, particularly where a main residence, such as a house or flat, changes hands between a husband and wife, between spouses, or obviously civil partners. And there have been, up to now, some quite interesting tax planning that can be done, and you will see in the notes that go along with this talk, I've given you another little mini case study called Godfrey and Sally, husband and wife, Godfrey and Sally, showing you how that rather nifty little piece of tax planning could be implemented. The suggestion in the consultative document is they're going to knock that one on its head. So again, if you've got clients who have taken advantage of the existing rules like Godfrey and Sally did, provided you sell before the 6th of April 2020, you'll be dealt with under the old rules, not the new rules. But I would stress that unlike the earlier examples that we looked at, this is a possible change. I don't think it's automatically in the lap of the gods. But do have a look at the example. Thank you for listening to this talk on these proposed changes to private residence relief. My name is Robert Jamieson.